are the 5 things that I will always check before buying a stock to increase my chance of winning. Welcome to episode 4 of Investing Made Simple, where I teach you the basic fundamentals of investing without all the BS. First, the sectors. There are 2 main types, defensive and cyclical. Defensive sectors like healthcare or consumer staples like food essentials, these are the things that people will need on a day-to-day basis. So they tend to be more robust against economic downturns. Cyclical sectors like travel, retail and tech, they tend to do well when the economy is strong, but they are hit the hardest when it isn't. So there's more growth potential, but also more price swings. Second, revenue and earnings per share growth. This tells you if the company is actually profitable and getting bigger and scaling up. You will want to see a positive trends over the last few years. One dip is normal, but consistently negative numbers, or if the sales is growing faster than the net profit, then both are signs of a red flag. Third, free cash flow yield. This is how much the hardcore cash that the company is generating every single year compared to its total value. More cash means it has more money to grow, also to pay down debts and also pay back shareholders. And as a rough guide, 5% or higher is healthy, 3 to 5% is solid, and anything below that could be a warning sign. Fourth, the debt level. How much debt does the company actually have in comparison to what it's worth, which is shown as a debt to equity ratio. As a rough guide, under 1 is considered relatively healthy, and the ratio of above 2 means that it's heavily relied on borrowed money, and it is riskier if the interest rate rises or if the profit dips. But just note that this varies by industry. Fifth, the price chart history. I will always check the 1-year and 5-year view of a stock to see a longer stretch of the price action. A steady gradual climb over the long term is a healthy sign that the company knows what it's doing with a steady strategy. A sharp spike followed by a quick crash is a sign to be cautious of. And if you want my free checklist to break down each of these in detail and where to look for them, then comment checklist and I send it to you for free. If you found this useful, then follow me for episode 5 where I break down the number that actually tells you if a stock is a good deal or just an expensive one. So I'll see you next time. Bye!